This is, of course, the critical question underlying everything that we are talking about here near term, and that could be absolutely formative for the calculus that the Fed faces and that we face as investors. So what we are going to look at here is, first, the degree to which the labor market remains scarred by the impact of the COVID-19 pandemic. We're going to look at the driver or the drivers, but in this case, we're going to focus on something very specifically long-term, of the trends in inflation and the demographic impact there. And then we are going to see what is actually cooling inflation now, how that is going to register in the broader economy, and whether that is then sustainable over time, and see what the actual costs are and what this is likely to mean going forward. So first, on to the scarring of the U.S. labor market in the wake of COVID. So one thing that we really want to look at here is the difference in participation rates in the labor force by age group. So what we're saying here is, first of all, what does it mean to participate in the labor force? It means that one is of working age and is either employed or actively looking for work. So if someone is either employed or, by that strict definition, unemployed, meaning not currently in a job, but actively looking. So these are the people that are participating in the labor force. And what we're doing here is we're looking at the percentage of these people in a given age group. So, for example, the big green one there is folks that are 55 years and older. And what you see is about 39% of the population of 55 and older Americans are participating in the labor force. That's what these numbers mean. Notice that during the pandemic, of course, with lockdowns and a surge in unemployment initially, we have a dramatic decline across all of the cohorts. And then for most of them, a very brisk recovery that all but erases the pandemic move. For 25 to 54-year-olds, for 35 to 44-year-olds, for 45 to 54-year-olds, we're almost fully, from the 25 to 54 range, recovered to participation levels before the pandemic. Almost. Some more than others. Importantly, also note, all of them are north of 80%. So very strong labor force participation in the 25 to 54 age groups. But there is a stark difference for 55 and up. Now, of course, their overall participation rate, understandably lower, closer to 40% rather than 80%, because, of course, this is an older cohort. Many more of these folks are already retired or no longer participating actively in the labor force as an age group. So the labor force participation rate here is structurally lower, just in general. But you'll notice that whereas just in terms of moves, the other cohorts have recovered for the most part. Again, almost. We haven't really seen meaningful improvement in that 55 and up group. So there was a dramatic decline And now it seems like we're kind of hovering around those levels. What does this mean? And why do we really care? Well, this is also the largest cohort in the labor force. Surely you've seen the various conversations about sort of the baby boomer generation being a huge part of the labor market and increasingly getting ready to retire, and what the implications of that might be. Usually these conversations are had sort of in the mass media in the context of entitlements and pensions and healthcare and things like this. We're going to look at it here from the inflation perspective. So this cohort, this 55 and up cohort, is both seeing the least recovery in labor force participation after the drop in COVID. You can see that here. And is also the largest cohort in the labor force. So the largest group of workers is also the one with the least recovery in participation, but their participation is structurally low. So let's see if we can contextualize this and compare apples to apples, as well as to relate this to inflation. Now, this next chart is going to be a little bit involved, so let's take it step by step. The green line here is the ratio of the participation rate for 55 and up and an average of the other cohorts. So we know that 55 and up is relatively low. We saw that here. The other ones are in the 80s. This one is closer to 40. So in absolute terms, that's a stark difference. But what we're interested in is a little bit different. We're interested in seeing how their share evolves relative to the others over time, and how that evolution might relate to inflation. So what does it mean for inflation that the others have recovered a long way and this one hasn't? And so that's what you see there in that green line. You can see it's trending down. And you can see that from about September of 2020, it's really accelerated down and stayed there. So the relative participation of 55-year-olds as relative to the other cohorts, you can see there, is not really recovering after a major hit during COVID. The other, of course, very important implication of what we're seeing here is that their share of the total was declining going all the way back to 2011, 2012. COVID was not a catalyst here, it was an accelerant. So it seems like the natural demographic glide path of the baby boomer generation retiring is slowly shifting the labor force participation of that cohort lower relative to the others. Because there's more of them than the others, we get the effect that we see on the red line there. That, of course, is wages. That is the employment cost index from the Bureau of Labor Statistics here in the US, quarter on quarter, but annualized rate. So you can see there, as the share of this large cohort relative to the others on labor force participation is coming down, so too labor costs are going up. Because what we're seeing is less and less relative participation from the biggest cohort in the labor force. So when we hear about structural labor shortages, this is what we're talking about. And you can see that this has been going on at this point, again, from 2011, 2012, give or take. And then when COVID happens, what you have is a rapid accelerant. So there's a sharp further decline, which anecdotally we can start to make sense of. If there has been a large swath of lockdowns, lots of people are disconnected from work, there is suddenly a mass shift into some sort of new way of organizing economic activity, and folks are just on the cusp of retirement, well, perhaps they'll just retire, maybe a little bit earlier than they intended, and just say, well, I was almost done, and this dislocation essentially means I might as well be done. And these folks are perhaps not returning along a similar kind of calculus back into the labor force with the same vigor as those folks that still have a longer way to go before retirement is on the horizon. So what you're seeing then, if these folks are not coming back with the same vigor, if we're going to have the green line as you see it here holding near these lows, well, then the impact on inflation, the parallel jump in the PCE index here, well, that might be a lot more durable than anything near term, because this will be a demographically significant trajectory for years to come yet. Behind the lines here, what you see is the PCE index itself. So you can see that as you get this shift in boomer employment, so too you get a pickup in wages, and then overall inflation, that's where it starts to build. And you can see the feedback into PCE, the peak there at 6. Now, it gets a little bit trickier still. This is labor force productivity. And this is actually why on this previous chart, I flagged September of 2020 as the place you can see where that big shift around the start of COVID occurs. Here, what you're seeing is that the last major peak in labor force productivity was, in fact, September of 2020. And since then, we have had a precipitous and accelerating decline in labor force productivity. The recent numbers right around a decline of 2% year on year, which you can see is the worst we've seen it since the mid-1970s. You'll recall that too was a very inflationary sort of period. But what we're seeing here then is doubly inflationary, because not only, looking back at this chart, is there a demographic shift whereby the makeup of the labor force is becoming more inflationary because this large cohort is leaving, and so overall labor force participation is weighed down because the largest cohort is leaving relative to the others and not coming back like the others. But also, the productivity of what's left is significantly declining. And again, we can hypothesize why that is. Perhaps with this shift from the 55 and up cohort, you're getting to a place where the labor shortages are making work as a whole less efficient. Perhaps you are losing a degree of expertise. It could be any number of things that could be contributing here. But the important thing, the thing to really take away from this, is that we are getting fewer workers. So labor force participation is shifting in a way that's inflationary because it's creating shortages, but also that labor is less efficient. It's less productive. What's left? And because of this, you need more of it to achieve XYZ outcome. And so companies' labor costs are more elevated still. Now, of course, the flip side of that is one could spend less on labor and grow less. And this is, of course, the simple upshot of what we're talking about when we look at what has been done to contain inflation so far. Now, what we're seeing on this chart, let's again unpack this. This might be a bit of a lot. Let's consider first the red line here is composite US ISM. So essentially what this is, we've looked at this kind of index before. This is that growth diffusion index. 50 on this index is neutral, not growth, not contraction. Above 50 is growth. The further it goes above 50, the faster that growth is. Below 50 is contraction. The further it goes below 50, the faster the contraction is. You can see the latest number here, 49.5. What that's telling us is that non-farm industry in the United States, so services and manufacturing, collectively are now shrinking. And you can see that that red line has been going down aggressively in recent months. This is, of course, the combination of inflation and the Fed's actions to contain it. The two gray lines. The light one is the 2-year U.S. break-even inflation rate. That's what's implied in bond markets. The darker one is the same sort of rate, but for a 5-year yield. So again, expected inflation over 2 years, expected inflation over 5 years, and then the bars there are the spread between those. So take a look at what we're seeing here. First, look at 2008. That's the global financial crisis. There's a dramatic decline in short-term interest rates. The 2-year break-even is collapsing because, of course, there is a mass inflation. Economic activity basically grinds to a halt. That's the red line sinking there. That feeds back into short-term inflation, which falls dramatically below 5-year inflation. And then there's a big spike in that spread. So investors are expecting inflation to be much higher in the future than in the near term, because in the near term, there's a mass recession and inflation has fallen off a cliff. As things normalize, you can see we get into this kind of range where steady growth, that's the red line kind of bobbing up and down in that relative narrow range from about 2010 all the way through about 2019. Not surprising why that is. Then you get this steady kind of range there on the orange bars where inflation in the future is expected to be a bit higher than in the near term because you have steady positive growth, which generally is a bit inflationary. When you have steady growth, that's where you have that kind of Goldilocks inflation situation where you have a bit, but not too hot, not too cold. That's what you want. That's what central banks are aiming for. Moderate growth and price stability. Then you have COVID. And again, there's a sharp decline in short-term rates as relative to longer. Near-term inflation drops significantly below 5-year inflation, and growth sinks. Not shocking. You can see there is a quick monetary response, so things don't get nearly as out of hand as they did in '08. And then as you move forward, you can see that there is a point there where the orange bars flip and are now below zero. That's the place where near term, the 2-year rate, the near term break even, you can see there spikes well north of the 5-year. And that's the inflation issue that the Fed is now fighting. And as the red line comes down, as the impact of Fed tightening sinks and drives the economy into a contractionary state, you can see the orange bars get less and less negative and are essentially squeezed out to where now the 2-year and the 5-year are about even, give or take. Just about 2%, a little bit higher. So what we can see here is that the way the Fed has achieved what is essentially pulling back inflation toward its target, almost, but certainly to close the gap between a shock to near-term inflation expectations and what is to come, thereby essentially cutting what is the biggest boogeyman for them, which is entrenched inflation expectations that then create a situation where markets start to extrapolate more and more inflation, consumers do as well, and inflation becomes entrenched over time, making it devilishly difficult to then undo. What the Fed has done is basically engineer a very significant decline in economic activity. And with the conversation now about, well, it's back to target, the Fed should let up and let the economy begin to expand again. Well, if that's what is indeed on the menu, then these very structural factors, which have not really moved with what the Fed has done, perhaps stand to drive inflation right back up. And so, by all accounts, the cost of bringing inflation down appears to be significant economic pain. Whereas to let up on that economic pain, at least for now, seems like it may not give a durable decline in inflation, but instead yield back to this dynamic, which then sets up the case for interest rates, even as they're adjusted back down, to find a higher low than they had before COVID, and to then remain higher over a longer period of time, giving us a very different economy, as we've talked about before, than anything that we've really experienced for the better part of 40 years. An economy where there isn't a structural down move in rates, in inflation over a 40, 50 years stretch. So, with that